Okay, hello students. Now in today's session, we are going to attempt the Mar-Jun 2025 attempt exam of AFM. And obviously, we're going to start with question number one. Okay, the question number one again states the following exhibits available on the left-hand side of the screen provide information relevant to the question. Kampai Company, Scal Company, financing acquisition, closure of factory. The information should be used to answer the requirements within your chosen response options. Obviously, seems to be like an acquisition question. Okay, let's start. So the first information is Kampai is a large listed company involved in the production of machinery for the logistics industry. Kampai is a large listed company involved in the production of machinery for logistics industry. Recently, it has been growing successfully by undertaking strategic acquisitions of competitor companies. It has made initial inquiries about acquiring Scal Company, a large unlisted company. This would be an important strategic acquisition for Kampai. So Kampai is a large listed company. It is involved in production of machinery. It has been growing by undertaking acquisitions. It has made initial inquiries about acquiring Scal, which is a large unlisted company. This would be an important strategic acquisition. Kampai has a good reputation both with investors and also with other stakeholders. The company is well regarded for making positive impact on the environment and also for looking after its employees. It is doing well financially. Share price has outperformed the market. Kampai, which is interested in buying Scal Company, has a good reputation with investors, with other stakeholders. Company is well regarded for making a positive impact on the environment, also for looking after employees, doing financially well. Share price has grown. Scal, the one we are acquiring, is involved in production of vehicles. Kampai, the buyer, makes machinery. This makes vehicles. Okay, both are in the logistics industry. It is regarded as being an innovative company which puts sustainability at the core of business operation. Its most recent venture has been to establish a factory in less developed part of the country to produce vehicles running on hydrogen power. This is considered to be beneficial for employment prospects and sustainability. Now, Scal, the one we are acquiring, it produces vehicles for logistics industry. We produce machinery for logistics industry. Both are in the logistics industry. Scal is regarded as innovative. It puts sustainability at the core of operations. Most recent venture has been to establish a factory in less developed part of the country to produce vehicles running on hydrogen power. This is considered to be beneficial for employment and sustainability. Exhibit 2. Currently, Kampai's 225 million shares are trading at 4 each. Its most recent PAT was 50 million. Kampai, the buyer, 225 million shares trading at 4. PAT was 50. Kampai's board of directors is proposing that Scal is acquired either through a cash payment of 8 for each Scal share or through a share for share exchange where a number of Scal company shares are exchanged for a number of Kampai shares, such that the additional value created from acquisition is allocated 50% to Scal shareholder, 50% to Kampai. Now, it has not told you 1 for 2, 1 for 3, 2 for 3. A share for share where such number of shares are exchanged for Kampai shares such that the additional value created from Scal's acquisition is allocated 50% to Scal, 50% to Kampai. So we have to find a share for share model where such ratio is generated that additional value created is distributed 50% to Scal, 50% to Kampai. So share for share ratio is not given. It's just saying such a ratio that 50-50% valuation is given, additional value is given to Kampai and Scal. Kampai's BOD has held initial positive discussion with Scal's board and majority shareholders. Scal's BOD and majority shareholders have indicated the premium on the current value of Scal of at least 25% for cash offer or 33% for share offer would be acceptable. This would be in line with market-based premiums paid for recent acquisition. Scal's board says that for cash, 25% premium and for share, 33%. Now, Kampai's board wants cash offer of 8, the buyer's boards, and share for share offer where such shares are exchanged with 50% additional value to Scal and 50% to Kampai. Now, Scal's board says that for cash offer, 25% premium and share for share, 33% premium. Scal's pre-acquisition value. Scal has 40 million shares in issue. It has 80 million of long-term debt on which interest is payable on an annual rate of 6%. Scal's most recent PBIT was 26.3 million after deducting 16.2 million TAD and other non-cash expenses. Scal makes annual investment of 14.1 million in non-current assets and working capital in order to continue operation. It is estimated company's cash flows will grow annually by 4% for the foreseeable future. Cost of capital is 11%. Tax rate is 20%. So this seems to be a free cash flow model type scenario where Scal's has 40 million shares, 80 million debt, interest is 6%. PBIT was 26.3 million after 16.2 million TAD and non-cash expenses. 14.1 million in non-current assets and working capital, and company's cash flows rose by 4% for foreseeable future. Perpetuity, cost of capital 11%, tax rate 20%. Scal's post-acquisition valuation. If Scal's post-acquisition valuation goes ahead due to increased efficiency and reduction in duplicated costs, Scal's PAT is expected to increase by 4.8 million annually. Its PE ratio is expected to be same as Kampai's current PE ratio. Additionally, there will be an immediate one-off increase in cash flow of 42.3 million from the closure of Scal's recently established factory, which is producing hydrogen-powered vehicles. See details in Exhibit 4. Currently, Kampai has 225 million shares. If you look at Exhibit 1, it's just saying that Kampai is a listed company which produces machinery. Kampai is a good reputation and it's doing well. Scal is involved in production of vehicles. It is innovative and it is establishing a factory in less developed part. Financial information said of Kampai has 225 million shares for each. PAT 50. Board wants 8 cash offer or share for share ratio where additional value is 50% for Scal and 50% for Kampai. And when they discuss with Scal's board, they want 25% premium for cash offer, 33% share for share. Scal's pre-acquisition valuation is 40 million shares in issue, 80 million debt, then PBIT, then 16.2 TAD and other non-cash, investment of 14 million in non-current assets, and cost of capital 11%. Post-acquisition valuation is saying that this is pre-acquisition valuation. Post-acquisition valuation is saying that due to increased efficiency and reduction in duplicated costs, Scal's PAT will increase by 4.8 million annually. P ratio will be same as Kampai's current P ratio, so we need to find Kampai's current P ratio. Immediate one-off increase in cash flow of 42.3 million from closure of recently established factory, which is producing hydrogen-powered vehicles. See Exhibit 4. I'm opening Exhibit 4, not opening Exhibit 3 at the moment to ensure that I understand everything. Scal has recently established a factory producing vehicles which use hydrogen power. Kampai's board is of the opinion this factory is not financially viable, does not align with Kampai's strategic direction. It is therefore thinking of shutting the factory once Scal company has been acquired. This closure is expected to generate immediate one-off increase in net cash flow to 42.3. So this factory was established by Scal, but Kampai thinks that we need to close it and it will result in 42.3 million cash flows. An internal memo about the possible closure of the factory was obtained and published by the popular press. The resultant reaction from the media and general public has been negative. Negative reaction centers around the job losses in the area, which is less developed, and that this closure would be a step backwards for sustainability. Newspapers have been particularly vocal in their criticism, suggesting that Kampai would be going against its core business values and destroying its reputation. This closure news will leak to the press, so press has now gone mad. And they are saying that this will reduce the job losses in the area because the factory will be closed. Step back for sustainability. Reputation of Kampai would be destroyed and blah, blah, blah. Kampai's board is very concerned about this development. One director suggested that Kampai should not close the factory. Another director suggested Kampai should not proceed with the acquisition at all. Overall, Kampai's board thinks these suggestions may not be viable and has asked for advice on what action could be taken to the negative reaction. Now, board is concerned. One director states, do not close the factory. Other states, do not acquire Scal at all. Overall, the board thinks suggestions are not viable, neither closure, not proceeding with the acquisition. Both suggestions are not good, and they are thinking what action can be taken. Exhibit 3. Kampai has minimal spare cash resource and is very close to breaching its current debt covenants. The both things acquiring Scal for cash payment will be challenging. Now, Kampai wants cash offer of 8 per share or share for share. So now Kampai has minimal spare cash, very close to breaching current debt covenants. Both things that acquiring Scal for cash payment will be challenging. Now, Kampai has no cash for cash payment. Kampai's finance director suggested that a mixed offer should be considered as well. The FD thinks that offering some cash, some shares to acquire Scal would be better choice. Now in Exhibit 3, it's just that you are short of cash. So finance director thinks that some cash, some shares. That's it. Exhibit 1, what are they doing? Exhibit 2, the financial information. Exhibit 3, financing the acquisition. And Exhibit 4, the closure of factory. Okay. Now, let's move towards the requirements. And before that, once read the question very carefully. Kampai makes machinery. It wants to acquire Scal. It has good reputation. Scal produces vehicles. Financial information, 225 million shares. Board wants 8 cash offer or a share for share offer. Scal wants 25% premium for cash, 33% share for share. Pre-acquisition valuation data of Scal is given, and post-acquisition valuation states that cash flows will increase by 42.3 million due to closure of factory, and the P ratio is expected to be same as current P ratio. Financing, they don't have cash, so finance director wants a mixed offer. Closure of factory. Scal established factory, but Kampai wants to close the factory. Press is reacting negatively. Board is concerned. One director saying acquire it. One director saying do not close the factory. And board wants what action to take. Let's move to the requirements now. Okay, that what is the requirement to in order to ensure the things are properly understood. Okay, so requirements are the same as we expect in question number one. Prepare a report for board of directors of Kampai, which includes an estimates of Kampai's PE ratio and additional equity value generated from the acquisition. An estimate of the percentage gain in shareholder wealth for Kampai's and Scal shareholders under cash offer. Estimate of number of Kampai shares allocated to Scal shareholders and percentage gain in shareholder wealth for Kampai's and Scal shareholders under share for share offer. Discussion on the acceptability of the cash and share for share offers to Kampai's Scal shareholders, including assumptions made in estimating additional value generated from acquisition. Discussion of financial issues faced by Kampai when acquiring Scal by cash, briefly conclude whether a mixed offer would be a better choice. No additional calculations are expected. Finally, a discussion of how Kampai's board might address the negative comments made about the factory. Professional marks will be awarded for demonstration of skill, communication, analysis, skepticism, commercial acumen. Okay. So if you to start a report, I've told you to start in a word. To, from, date, subject, and introduction. Okay, to prepare a report to board of directors. From, nothing is mentioned. From management accountant or CEO, leave it. Date, subject, small one, 2 words. Acquisition of Scal. Okay. Introduction, this report, then all requirements. Estimates Kampai's company PE ratio and additional equity value generated from acquisition. It then estimates percentage gain in shareholder wealth for Kampai's and Scal shareholders under cash offer. It then estimates number of Kampai's company shares allocated to Scal company shareholders and percentage gain in shareholder wealth. Wealth for both company shareholders under share for share offer. It can discusses acceptability of cash and share for share offer. Share for share offer to Kampai and Skal shareholders. It then discusses financial issues faced by Kampai when acquiring Skal company via cash and whether mixed offer is a better choice. It finally discusses how Kampai's board might address negative comments about factory closure. Now I've told you that once you have all the requirements in hand, okay, you should start to from date subject introduction. And once you have all the requirements in hand, then every requirement will have a separate heading, right? The first requirement will have its own heading. Okay, this is the first requirement. Second requirement. You can use the copy paste. Third requirement. Okay. Fourth requirement. Okay. Fifth requirement. And finally, the sixth requirement. Have taught this thing in detail that all requirements will be dealt with. Okay. But if any requirement is a calculation requirement, it will refer to the appendix. And if any requirement is a discussion requirement, I will write it here. Okay. So I would suggest you to please note this so that I can move forward. Okay. Okay. Now, if you talk about the requirements, I told you that once you have made the format of report like to from date subject introduction and then introduction, this report, every requirement, one, two, three, four, five, and then all the requirements with their headings, then solve each part separately. First part, Campai's P ratio, additional equity value generated from acquisition. Does it seem a theoretical requirement or a calculation requirement? So this is not a discussion where you can write it inside this. If it's theory, write it here. But if it's a calculation requirement, then you need to refer to appendix. So I will write here appendix. Just remove this underline tab. Appendix 1 shows additional equity value calculated and PE ratio. PE ratio is whatever you find, and additional equity value, whatever the answer is. Okay. So I will refer to appendix 1, and for calculation, I will refer to spreadsheet. And here I'm writing appendix 1. What's it asking? Campai's P ratio. So you know the formula of P ratio? Market price per share, and you need earnings per share. So you get the PE ratio of Kampai. So what's the market price per share of Kampai? Because it's Kampai's P ratio, I will write Kampai 4 per share. Earnings per share. How do you find earning per share? PAT 50 less preference dividend 0 over number of ordinary shares 225 million. So profit after tax 50 less preference dividend 0 divided by number of ordinary shares 225 million. Okay, so market price per share 4 over EPS 0.2222, 18. So this is Campai's P ratio, which is found to be 18 times. It's simply market price per share over earnings per share. And what else this was asking? Campai's P ratio. Additional equity value generated from acquisition. So additional equity value. Now, when I want to find the additional equity value from acquisition, okay, so additional equity value from acquisition, for this purpose, we need to find the pre-acquisition value as well as the post-acquisition value. Only then we can take the difference and get the additional equity value, because for that we need the pre-acquisition value as well as the post-acquisition value. Okay. So we have information about pre-acquisition value and about post-acquisition value. We can get the additional equity value calculated. Okay. So pre-acquisition value, 40 million shares, 80 million debt, interest payable at an annual rate of 6%. PBIT was 26.3 million. After deducting 16.2 TAD and non-cash expenses, annual investment of 14.1 million in non-current assets and working capital in order to continue operations. Cash flows will grow 4%, cost of capital 11%, tax rate 20%. Okay. And then post-acquisition value is also given. So to find additional equity value, we might need to calculate the pre-acquisition value and the post-acquisition value. Now, one thing which is really important to find pre-acquisition value and post-acquisition valuation, because to get the additional equity value from acquisition, you first need the pre-acquisition valuation. Skull Company. Okay. And then you will be needing the post-acquisition valuation. Now, the biggest important thing is that which method to use to find the pre-acquisition valuation, right? Look at the data. 40 million shares, 80 million debt, PBIT 26.3 after deducting 16.2 TAD and other non-cash expenses. Scal makes annual investment of 14.1 million in non-current assets and working capital in order to continue its operations. It is estimated company's cash flows will grow annually by 4% to foreseeable future, non-current assets, working capital, cash flows. So it seems it's FCF method for pre-acquisition valuation. And since cost of capital is given, so FCF to company. So let's write the format of FCF to company here. Revenue, cash cost, TAD. Revenue, cash cost, TAD. I've told you when you deduct it, you get operating profit or PBIT. Then there is interest which doesn't come, so PBT. Taxable profit, PBT. Then we pay tax, add TAD, investment, NC, and working capital. Add back TAD. Less investment in working capital. Less investment in NCA. Right? What do we get? FCF to company. Discount rate. WACC. We get present value. Okay. So present value of all future FCF is the value of company. Okay. Less value of debt. We will end up with value of equity. Okay, because the only thing that matters here is that the requirement is P ratio, additional equity value from acquisition. So I've got the P ratio, market price per share of Kampai, and EPS, PAT less preference dividend over number of ordinary shares. I get P ratio. Additional equity value from acquisition. So additional equity value is to find the additional value, we need the pre-acquisition value as well as the post-acquisition value. Okay. So pre-acquisition value, post-acquisition value data was given, but with method, it seems like non-current assets, working capital, WACC. So it's FCF method. Okay. So let's start with what is given. PBIT, operating profit, 26.3 million is given. Okay. This is obviously after deducting cash costs and TAD. After deducting 16.2 million TAD and cash costs. Okay. So this is after deducting. We get operating profit. Interest doesn't come here. So get PBT, 26.3. Tax, what is the tax rate? 20%. Okay. Add back TAD, 16.2. 16.2. Investment in working capital and NCA, 14.1. It's combined given. Okay. You will get FCF to company, right? Okay. 23.14 is the FCF to company. Okay. Now, This is the current data. This is the current data. That question states that 26.3 million most recent PBIT, 16.2 TAD, investment 14.1. Estimated the company's cash flows will grow by 4%. Okay, so what is the future FCF here? So future FCF here is, it's 1, 2, 3, 4 data not given, year 1, year 2, year 3, 4. It's just written that cash flows will grow annually by 4% for the foreseeable future. So you all know direct for the foreseeable future means 1 to infinity. Directly for the foreseeable future means 1 to infinity. So it's 23.14 into 1.04. This is the future FCF. Discount rate WACC. How do you get 1 to infinity WACC here? Last year's discount factor before 1. What is the last year? Discount factor 0, 1. Over WACC 11% minus G 4%. Okay. Present value of all future FCF. So it's C19, C20. Present value. Okay. Less value of debt. 80 million is the debt. So value of equity. $263.79 is the pre-acquisition value. Let me repeat it again. It's a professional paper, right? So you need to think many things that how do we get the additional equity value? So additional equity value is basically generated by gathering pre-acquisition value as well as the post-acquisition value. Only then we can know the additional equity value. Okay. So if I talk about the pre-acquisition value, so pre-acquisition value, uh, as per the data given, it seems that non-current assets, working capital, PBIT, it seems in FCF method. So since WACC was given, I applied FCF to company format. So FCF to company format is revenue less cash cost, TAD, PBIT, which is given. Interest doesn't come in here. PBT, tax is paid. TAD add back, investment and CA, FCF to company. But according to the FCF method, the value is the present value of future FCF, not today's FCF. We took today's profit. Value is future FCF, present value of future FCF. So what is the future's FCF? It is saying that FCF will grow by 4% for the foreseeable future. Now, if 1, 2, 3, 4 is given and then foreseeable future, so it's 5 to infinity. Direct for the foreseeable future, I've taught you multiple times, it's just 1 to infinity. Direct for the foreseeable future directly means 1 to infinity. So 1 to infinity, future FCF 4%. Discount rate, last discount factor of 0 is 1 over WACC minus G. Present value less value of debt. This is the pre-acquisition value. Okay. Now I need additional equity value. I have the pre-acquisition value. Now let's move towards the post-acquisition value, because that's the only way you get additional equity value. Now, how do we get post-acquisition value? If acquisition goes ahead due to increased efficiency and reduction in duplicated costs, Cal's PAT is expected to increase by 4.8 million and its P ratio is expected to be same as Kampai's current P ratio. So if acquisition goes ahead, PAT will increase by 4.8 million. Okay. P ratio will same as Kampai's current P ratio. One-off increase in cash flow of 42.3 million. So post-acquisition valuation. PE ratio will remain same as of Kampai, 18 times. So for P ratio, if it's same, then I think I don't have the FCF data and post-acquisition valuation. I just have the PE ratio, so I will find value under P ratio. Just P ratio into PAT. So what is the PAT? What is the PAT? Let's find the PAT here. PAT will increase by 4.8 million. PAT will increase by 4 point. So PAT will increase by 4.8 million. P ratio remains same. So let's find post-acquisition value under P method. P is same. PAT increased by 4.8 million. So let's try to find the current PAT. PAT. So current PBIT. PBIT is given. 26.3. 80 million known, 6% interest. I get the interest and taxes 20%. Okay. So PBIT is 26.3. Interest company is paying is 80 million debt into 6%. You get PBT. Then you pay tax 20%. You get current PAT. $17.2 is the current PAT, and to find the post-acquisition value, it's given that P ratio will remain same. So I'm trying to find value under P ratio method. P ratio after valuation is 18 times. What is the PAT? Increasing by 4.8. So 17.2 is the current PAT. It's increasing by 4.8 million, right? It's written 4.8 million after acquisition. So PAT will become 22 million. Okay. Now, value under P ratio method is PE ratio into PAT. So P ratio into PAT is the value 22 into 18, 396 million. That's the post-acquisition value. And one more thing, which is clearly stated here. In the post-acquisition value that, okay, P ratio was constant, PAT increasing by 4.8. So I just found the current PAT and increased it by 4.8. PAT into P ratio, I got the value, but there will be a one-off increase of 42.3 million as well due to closure. So your value will increase by 42.3 more. So 438.3 million is the post-acquisition value. And this was the pre-acquisition value, right? Now I can find additional equity value from acquisition. What was the post-acquisition value? 438.3 million. What was the pre-acquisition value? It was 263.79 million. So additional equity value is 438.3 minus 263. Okay, so let me just review it one more time for you so that you can copy. And there are one or two questions as well, which I need to address immediately so that it doesn't become a bit confusing. First of all, I have solved this requirement of 8 marks with stated estimate of Kampai's PE ratio. So P ratio was market price per share for EPS, PAT less preference dividend over number of ordinary shares. Okay, I got the P ratio. Additional equity value from acquisition. So for additional equity value, I need the pre-acquisition value and post-acquisition value. Okay. For pre-acquisition value, the data seems to be suitable for FCF method. So I made the format of FCF, revenue, cash cost, TAD, FCM. But as per the FCF method, value is the present value of future FCF. So future FCF is increasing by 4%. I applied the WACC, present value of future FCF, not the current FCF, less value of debt, I get pre-acquisition value. For post-acquisition value, I read the data. It was not FCF method. For post-acquisition value, its P ratio was remaining same. And into PAT. PAT was increasing by 4.8. So I needed the current PAT, which I got from PBID. PAT into P ratio, I got the value. The value is increasing by 42.3 post-acquisition value. Less pre-acquisition value, I get the additional equity value. Okay. Now there are two questions. First question, why did I add 42.3 after the value? Why didn't I add it in before? How would I know? It's a very simple thing. Here it's clearly saying that profit will increase by 4.8. Had it said profit will increase by 42.3, I would have added in profit. Here it's saying there will be an immediate increase in cash flows. That's why I didn't add it in profit, right? Had it said that the profit would have increased by 4.8 and 42.3, I would have added 42.3 in profit as well. Okay. But it's saying only the cash flows will increase, so I can't add it in profit. Profit was 4.8. I added into P ratio, I got the value, and then any other one-off cash increase that has to be added in value, not in profit. Okay. Secondly, many people will message me after this that you have made a standard format for additional equity value, like we need to find the combined company value less individual company values to get the additional equity value. Now it's completely different. Yes, there is no information about combined company value here. So if you don't have any information for combined company value, how can you find the combined value less individual values of Kampai and Skull to get the additional equity value? Had the combined company data been here, I would have definitely computed additional equity value like this. Combined value less Campai's value, less Cal's value, I get the additional equity value. But since combined company data was not given, only the pre-acquisition value and post-acquisition value was given. So I found the pre-acquisition, found the post-acquisition, and deducted to get additional equity value. Okay, you can copy this. Okay, now let's see what the next requirement is. The first requirement, we computed Campai's P ratio, additional equity value generated from the acquisition. Okay, pre and post acquisition difference. Then estimate of percentage gain in shareholder wealth for Campai's and Scal shareholders under cash. Now, this is a very small form of requirement. Percentage gain in shareholder wealth for Kampai and Scal shareholders under cash. Where is the cash offer here? Only this. So currently, Campai's 225 million shares are trading at 4 each. Most recent pack was 50 million. Board of directors is proposing that Scal is acquired through a cash payment of 8 per share. So it is asking percentage gain in shareholder wealth for Campai's and Scal shareholders under cash offer. So let's start this. What P ratio is 18 times and additional equity value to 174.5 million. Okay. Now, second, percentage gain in shareholder wealth for Kampai and Scal under cash offer. Calculation requirements, we write appendix. Two shows percentage gain in shareholder wealth for both Kampai and Scal shareholders. Percentage gain for Scal shareholder is whatever, and for Kampai is whatever I'll got. Okay. So percentage gain in shareholder wealth for both shareholders. Now let's start it. And percentage gain, appendix 2. Percentage gain for Scal shareholders. Okay. Now for percentage gain for Scal shareholders, you need under cash offer, current share price, cash offer. What is the current share price for Scal company? Now for Scal company, current share prices, you found the value 263.79 million. This found the 263.79 million. Scal value here above. What are the number of shares of Scal? 40 million shares. So So it's 263.79 divided by 40 liters. Okay. And what is the cash offer? Their current share price is 6.59 and they're getting cash as 8. So what is the percentage gain? I've taught you. Take the difference. 8 minus 6.6 percentage gain divided by the old 21%. Okay. This is the percentage gain under cash offer. Okay. It's current share price and compare that with cash offer, right? I think this is the way we taught you before, that whenever you need to find percentage gain under cash offer, it's just the current share price and the cash offer. The current share price is this, and the cash offer you got is 8. So you got the percentage gain. Okay. Now let's start percentage gain for Kampai shareholders. Now, if you want to find percentage gain for Kampai shareholders, it's simply the current share price which is for Kampai 4 and post acquisition share price under cash offer. Okay, current share price and post acquisition share price under cash offer. Now, this type of question has been discussed in the previous classes as well. That if you want to find post acquisition share price under cash offer, pay attention. How do you get post acquisition share price under cash offer? Now, for Kampai, you see that existing value of Kampai is 900 million, right? 4 per share into 225 million shares. It's 900 million. Okay. Post acquisition value will be like this, that its value was 900. Okay. Plus it got a company acquired Skull. So the benefit they got was 174.51 from the acquisition of Skull. This. Okay. 900 was their value, but they acquired Skull. So whatever Skull's value was there, you can say that I should have added complete 438.3 million. Okay. Then I would have deducted the pre-acquisition value already. So I will only add 174.51. Why? Because if 900 is the value and you got Skull, 438.3 value, combined value, okay, less its pre-acquisition value because 263 was already there. Okay. Or you can do it like this, rather than if you're confused in adding 174.5. That post-acquisition value is 900 plus, this is for Kampai, plus I acquired Skull. So Skull's value has become 438.3 million, right? But this is the post-acquisition value, but The value reduced also because I paid in cash offer 8 per share into how many shares it had? 40 million shares. So if we talk about that post acquisition value is 900 plus we acquired Skull, so 438.3 less we paid how much? 8 per share into 40 million shares. So post acquisition value is 1018.3 million. And if I want to get post acquisition share price under cash offer, so value is 1018.3 million. And under cash offer, you just took the shares and paid cash. No shares increase. Shares only increase in share for share exchange. They don't increase in cash offer. So 225 million shares because Kampai acquired them for cash and the shares are still 225. It's 1018.3 divided by 225. This is the post acquisition share price. So post acquisition share price under cash offer is I35. And if you want to get the percentage gain, it's simple. The difference over 13%. Okay. So I've got the percentage gain for both group of shareholders. I will just repeat it so that you don't have any problems in that. Percentage gain for Scal, current share price. This is the current value, 263.79 million of Scal divided by the number of shares. What are the number of shares of Scal? 40 million. So I got the current share price. Okay. And cash offer, they're getting 8% gain. For Kampai, just pay attention, current share price is 4. What is the post-acquisition share price? Now, post-acquisition share price is the merging of both companies, 900 Kampai plus 438.3 Scal. You got the company's value, but the value will decrease because you paid under cash offer 8% to 40 million shares. So both values less the cash paid. Post-acquisition value is 1018.3. The number of shares don't increase. So you get the post-acquisition share price 4.52, and then it's the percentage gain. Okay, this has been done many times that the post-acquisition share price for the buyer is the merger of both companies less the cash paid. The post-acquisition share price for the buyer is now acquisition, both companies add less the cash paid. Okay, please copy this. Okay, now let's move towards the next requirement, which states estimate of the number of Kampai shares allocated to Scout shareholders and percentage gain in shareholder wealth for Kampai's and Scout shareholders under share for share offer. Okay, now you need to estimate number of shares allocated to Scout shareholders, percentage gain in shareholder wealth for Kampai and Scout shareholders. Now, not under cash offer, you have done this. This is under share for share offer. So under share for share offer, the percentage is current share price and post acquisition share price. Okay. So Appendix 3. The percentage gain in share for share offer for Skal company shareholders and the percentage gain for Kampai shareholders under share for share offer. We know that under share for share offer, current share price post acquisition share price, current share price post acquisition share price. We get the percentage gain. Now we have got the post acquisition share price above under cash offer. Merging of both companies less the cash paid. Okay, merging of both companies less the cash paid. Now we need to find percentage gain under share for share offer, but for that you need post acquisition share price under share for share exchange. So let's see what is happening in share for share offer. It's not saying how many shares should be issued. It's saying number of Skal share are exchanged for a number of Kampai shares such that additional value created from Skal's acquisition is allocated 50% to Skal shareholders, 50% to Kampai shareholders. It's not saying issue how many shares, issue 243, 142, 145. Issue such number of shares such that additional value created from acquisition is allocated 50% to Sky and 50% to Kampai shareholders. Now, we all know additional value created is this. We all know additional value created $174.51. Such shares need to be issued under share for share offer. That 50% additional value is allocated to Skulls, 50% to Kampai. So 50% to Kampai shareholders, 50% to Skull shareholders. Okay. That means $87.255 for Kampai, 87.2552 Skull shareholders. Right. Now, this will make post-acquisition value of Kampai 900 plus 87.255, 987.255 million, right? And number of shares Kampai has is 225 million. So Kampai post-acquisition value per share will be 4.3878 per share, post-acquisition value per share. And this will make post-acquisition value of Skal company what was the pre-acquisition value? 263.8. plus 87.255. $351. Now pay attention to this point. Pay attention to this point. What I'm stating now. Now, post-acquisition value of Skull is 351.055 million. Kampai has to acquire Skull, whose value is 351.055 million. And if it gives its shares are 4.3878 per share. So what will happen is that Kampai is acquiring Skull worth 351.055 million. Kampai is giving its shares having price 4.3878. Okay, so number of shares Kampai must give to Skull. It's acquiring a company worth 351.055 million, and it's giving a share having worth of 4.3878 per share. So it means it has to issue 80 million shares. Okay, and since Skull has already 40 million shares, giving 80 million shares means Kampai must give 2 shares for 1 Skull share. I have to repeat it, otherwise it will become a bit complicated. You need to pay attention to this fact that the requirement is estimate of the number of shares allocated to Skull shareholders, percentage gain in wealth for Kampais and Skull shareholders, now not under cash offer, under share for share offer. If you need to find percentage gain under cash offer, I've already done it. Here, current share price, cash offer, current share price, post-acquisition share price under cash offer, merger of both less the cash paid. Okay. Now, percentage gain under share for share offer is current share price for both and post-acquisition share price. You get percentage gain. Okay. How do you get post-acquisition share price under share for share exchange? This is the working, because you need to find how many number of shares must be issued. You need to find how many shares must be issued. You need to find that as well. Now, additional value created is 174.51, and in share for share offer, it's stating that in share for share offer, it's stating that such number of shares are exchanged that additional value created is allocated 50% to Skull and 50% to Kampai. So additional value created is 174.51, 50% Skull, 50% Kampai. That means 87.255. So what will be the post-acquisition value of Kampai? 900 is the value plus 87.255. It will get 987. Number of shares Kampai is 225. So Kampai's post-acquisition share price is 4.378. And the post-acquisition value, if this 50-50% is distributed, 263.8 is for pre-acquisition value of Skull, and 87.255 is the benefit they are getting in this transaction. 351.055 million is the post-acquisition value of Skull, and 900 plus 87.255 is Kampai. Now, Kampai is acquiring Skull worth 351, and Kampai is giving its share, having a price of, after this transaction, 4.378. That means it must give them 80 million shares. We divided it. We are getting a company for 351. And we are giving our share of 4.3878. That means 80 million shares need to be given. And since Skull already has 40 million shares, if Kampai gives them 80 million shares, it's a ratio of 2 share for every 1 share. Okay. You can note that. Then I will explain the further thing of post-acquisition share price and percentage gain. Otherwise, it will become too much data. Okay. You need to find the number of shares based on this share for share, where such number of shares are exchanged, that additional value is allocated 50-50. So I got additional value. This from part 150, 50% means 87. Both companies valued increased by 87.255 in the share transaction. 900 plus 87, 262 plus 87. Now, if SCAL is worth 351.055 and Kampai wants to acquire it under share for share exchange by giving a share, its share price is 4.3878 after that. So it needs to give 80 million shares. Since SCAL has 40 million shares, giving 80 million shares means one SCAL share gets two shares. Okay. Okay, now once we are clear with this stuff, that it's 80 million shares being given, that is two shares for every one share of SCAL. Now we can find the main thing that's in requirement, percentage gain, sorry, estimate number of Kampai shares allocated. So Kampai shares allocated are 80 million. Percentage gain in shareholder wealth for Kampai and SCAL shareholder under share for share. Now, under cash offer, you have done this current share price, cash offer. Okay, let's check what's the uh, thing in share for share exchange. It was current share price, cash offer, and in the buyer's case, current share price and the post-acquisition share price, that was the combined value less cash paid. Now, in terms of share for share offer, if we want to find percentage gain for Kampai, Kampai's current share price, as mentioned in the scenario, is 4, right? And as per the share for share offer, not the cash offer where you merge both and less the cash paid, as per the share for share offer, the post-acquisition share price is 4.3878. So percentage gain is the difference, 0.3878 over base 4, 9.6%. Okay, or 9.7%. For SCAL, current share price is this, 260.79 or 40 million shares. 6.59, 475. Okay. Post-acquisition share price is obviously they gave their share and they got now the post-acquisition share price, the combined value. So post-acquisition share price is 4.3878, but here you need to pay attention that SCAL is giving its shares for 6.59,475. And in return, it's getting the post-acquisition combined company shares, which worth is 4.378, but they're getting two shares in return. Okay. 4.3878. This has been discussed in the classes into two. They gave their one share, and in return, they got two shares of the combined company. Okay. Kampai paid them two shares against their one share. So 4.378 is the word for two shares. Okay. So it's just the difference, 8.7756 minus 6.59475 divided by 6.59475, the base. It's 33% approximately. Okay, so we have got the percentage gain under the share for share offer for both group of shareholders. Okay, now for Kampai, it was very easy. One share has worth of 4. Post-acquisition share price is 4.3878. But for Scale, they gave one share, but in return, they got two shares. Okay, so I think you should copy this, and then I will explain the full part A, B, C, 1, 2, 3 again, so that you have a sound understanding, and then we will push to the remaining 4, 5, 6 parts. Okay, please copy this. Okay, so I think we have had done the first, second, third part, prepare a report. So let's just fill the values as well. That Kampai's P ratio, additional equity value generated from the acquisition. So I have written That appendix 1 shows additional equity value, P ratio 18 times, equity value 174.51 million. Okay. Then percentage gain in shareholder wealth. Appendix 2 shows percentage share gain in shareholder wealth for both Kampai shareholders and Skal. So let's just see that for percentage gain in Appendix 2. Skal 21%, 13%. Skal 21%. 21%. And for Kampai, 13%. Okay. And then the number of Kampai shares allocated to Skal. Shares allocated to Skal. That is 80 million shares. And percentage gain in shareholder wealth for Kampai as 9.7%. And for Skal shareholders, okay. Okay, so let me just quickly recap all the requirements. The first requirement was Kampai's P ratio, additional equity value, then percentage gain in shareholder wealth, cash offer, and then percentage gain for both under share for share offer. In my opinion, the only technical part up till now is the share for share part, the number of shares, but still we will repeat it. First, Kampai's P ratio. So you were provided with Kampai's PAT, less preference dividend over number of shares to 25 million. You got the Kampai's EPS, market price per share was 4, you got P ratio, and then additional equity value generated from the acquisition. So for that, we used to find the combined value, less individual values of both to get additional value. But here, combined value data is not given, through which you can find the combined company share price. The data given is pre-acquisition value and Skal's post-acquisition value. So pre-acquisition value was something investment in non-current assets, PBIT. So we started with pre-acquisition valuation. Revenue was given, cash cost TAT, PBIT was given. Interest doesn't come in FCF to company, PBT, tax, add back TAT, investment, working capital, NCA. You got FCF to company. This is not relevant because as per FCF to company method, the value is the present value of future FCF, not the current. So we made it future FCF. Okay, discount factor last year's over WACC minus G. Okay, present value, less value of debt, value of equity. Okay, now for post-acquisition valuation, it was saying that P ratio is expected to remain same as Kampai. So through this, I got the hint that I need to compute through P ratio. P ratio will remain same. PAT. PAT is current PBIT given. I deducted interest. I deducted taxation. PAT increased by 4.8, multiplied by P ratio to get value, and then additional value. 438. 438 less pre-acquisition value, I got additional value created. Okay. And then it asks for percentage gain in wealth for Kampai and Skal shareholders, the cash offer. So cash offer percentage gain for Skal. Current share price was 262 and 79 over 40 million shares. This cash offer was this. So percentage gain for seller or buyer, current share price. What is the share price in cash offer? Adding the value. 900 plus whatever the company we are getting, less the cash paid. So post-acquisition value is the increase in value less the cash paid divided by number of shares. Okay. You got 4.52578 because this is how you get the post-acquisition share price and cash offer that combine the values of Kampai and whatever you're getting and then deduct the cash paid. Okay. This was a very important part, number of shares allocated to Skal shareholders, percentage gain under share for share offer. So it clearly mentioned that share for share offer. Such number of shares are exchanged that additional value created is 50% to SCAL and 50% to Kampai. Such number of shares need to be issued. Additional value is 50% to SCAL, 50% to Kampai. That's a very important thing, that such number of shares need to be exchanged. That additional value created is 50% SCAL, 50% Kampai. So I just did this, that the additional value created is 174.51 from part A, 50% to both. Okay, so how many number of shares need to be issued? Now, after getting this, Kampai's value will become 900 plus 87.255, the value created, 97,225 million shares. That means Kampai shares would be worth 4.378. And Skal company's value is 263.8, and it will get this amount in share for share exchange, 50% to this. Its value will become 351.055. Now, Kampai is acquiring Skal. Worth is 351.05, and it is not paying cash. It is paying 4.3878 per share, its own share. Okay, its own share is being paid in share for share, so 4.3878 is the own shares worth. And we are acquiring Skal worth 351.055. Okay, so that means 80 million shares must be given to Skal. Skal already has 40 million shares. Giving them 80 million share means you're giving 2 shares for every 1 share. And now percentage gain for Kampai, its current share price 4. They're giving a share worth 4.3878. They got the share 4.3878. So percentage gain is 9.7. For Skal, current share price is 6.6. They're getting a share of 4.378, but 2 shares they're getting 8.77. So percentage gain is 33%. Okay. Now the next requirement is discussion of the acceptability of cash and share for share offers to Kampai and Skal shareholders, including the assumptions made in estimating the additional value generated from the acquisition. That's a very easy question of 7 marks. Assumptions made in estimating the additional value generated. So you generated the additional value in part A. So whatever assumptions you took in estimating the additional value generated, you need to write that. And discussion on the acceptability of cash and share for share offer for Kampai and shareholders. Okay, it's a discussion part, so we'll write it in Word. So assumptions made. Following assumptions were made in estimating additional equity value from acquisition. Whenever we computed the additional equity value, what assumptions did we made in estimating additional value? We need to write that. Following assumptions were made, 2, 3, 4, maybe getting 3, 4 marks. And then discussion on the acceptability of cash and share offers. We need to discuss the acceptability of cash and share offers. Okay, so we'll just start it. What assumptions were made in additional equity value? So here is the solution of additional equity value. Okay, now if you check the working of the additional equity value, what assumptions you have taken, the market price per share is 4, EPS is calculated, you got P ratio. And then for additional equity value created, you said the revenue, cash cost, TAD, operating profit, then interest, then PBT, then tax, and add back TAD, working capital, FCF to company, then discount rate, present value, future FCF, value of debt, value of equity. Okay. And then we found the additional equity value by deducting the pre-acquisition value from post-acquisition value. In post-acquisition value, the P ratio will remain same. So we can write this as assumption. It is assumed that PE ratio after acquisition will remain same as Kampai's PE ratio. Remember, this was mentioned here as well. It's expected to remain same as Kampai's current P ratio. So this is an assumption. You got the marks, but you have to earn professional marks as well. So skepticism, acumen, questioning mind. What is the basis of this assumption needs to be discussed. Similarly, you have used the FCF method. So it is assumed growth rate of FCF will remain constant till perpetuity, whereas it can change depending on circumstances. Okay. We have also assumed that there will be an immediate one-off increase in cash flows of 42.3 million. It is also assumed that closure of factory will result in immediate one-off increase in cash flows of 42.3 million. The basis of this is unknown. Not on what basis company computed this. You can write about the cost of capital, that discount rate of 11% has been assumed constant till perpetuity. It is also assumed that discount rate and tax rates will remain constant till perpetuity. Economic changes may affect these figures. So I think you have got 3-4 assumptions in estimating additional equity value. Now you have to make a discussion part in part 4, discussion of acceptability of cash and share for share offers for Kampai's and Skal shareholders. Okay. So let me just write about the discussion of the acceptability of cash and share for share offers. You have done the cash and share for share offers. The percentage gain is this and this. And in share for share offer, the percentage gain is this. So acceptability of cash and share for share offer for both Kampai's and Skal shareholders. Now, if you want to talk about the acceptability of cash and share for share offer, so you see that for Kampai shareholder, cash offer is resulting in gain of 13% and share offer is resulting in of 9.7%. As far as acceptability of cash and share for share offer is concerned, Kampai's shareholders are getting 13% gain in cash offer and 9.7% gain in share for share offer. So for them, cash offer seems acceptable. For Skull shareholders, cash offer is giving them gain of 21%. And share offer is giving gain of 33%. So for them, share offer seems more attractive. Also, they expect a premium of 25%. So it was written in the question. Premium of 25% for cash offer and 33% for share offer would be accepted. On cash offer, which is not being met, and they expect premium of 33% on share offer, which is being met. So they will be inclined towards share offer more. Even though for Kampai, cash offer is better, they can still accept share offer because it is mentioned that this acquisition is of strategic importance. Remember, it was mentioned somewhere in the question. Exhibit 1, I think. Important strategic acquisition. Okay. So even though they are getting less in Kampai, shareholders want share for share offer is giving them 9.7% gain. Cash offer is giving them more gain, right? So they might expect to get a cash offer. But still, since Skal shareholder will demand a share offer, they're getting more premium and stuff like that. They may tilt their focus towards share for share offer, even though they're getting less return, the Kampai shareholders, because in any ways it's of strategic importance, right? So I think for 7 marks, that's enough. 3-4 marks for this, 3-4 marks for assumptions, right? You can note this point 4 so that we can move towards the point 5-6 and close it. So report seems to be going in a good manner to from date subject introduction, then appendix 1, appendix 2, appendix 3. Finally, this appendix 4. Okay, now let's see what's the requirement for is, sorry, 5 is a discussion of the financial issues faced by Kampai company when acquiring Skull by cash and briefly conclude whether a mixed offer would be a better choice. No calculations are expected. No need to any calculation. Just discuss financial issues faced by Kampai when acquiring Skull by cash. What are the financial issues faced by Kampai when it acquires by cash? Briefly conclude whether a mixed offer would be a better choice. Okay. I think there was something mentioned in the question regarding this. Exhibit 2 was just about valuation. Exhibit 3. Kampai has minimal spare cash resources and is very close to breaching its current debt covenants. The board thinks acquiring Scal for cash payment will be challenging. Kampai's finance director suggested that a mixed offer should be considered as well. FD thinks offering some cash, some Kampai shares to acquire Scal would be a better choice for Kampai. But this is the only information, and from that, 7 marks are there. That what are the financial issues faced by Kampai when acquiring Scal by cash? Briefly conclude whether a mixed offer would be a better choice. So, discussion requirements I will write here. It is clearly evident from the information provided that Kampai company has minimal spare cash resources. So it will be difficult for them to acquire Skull via cash. Together with this, they are offering a cash offer of $8 per share. But Skull shareholders are not getting the premium they want of 25%. We have just seen here in the spreadsheet that in cash offers, Skull shareholders are getting 21.21%, but they want 25% in cash. I just discussed it in the previous part as well. So they might ask to increase cash offer, which can be more challenging for Kampai. Now, this is the problem, that financial issues, but obviously this is not worth 7 marks. That Kampai's minimal spare cash resources is difficult to acquire by cash. They're offering a cash of 8 per share. Shareholders are not getting the premium they want. They might ask to increase cash offer, which might further put pressure. One way of resolving this, if company does not have spare cash, is to borrow. Now, if you see, it's close to breaching current debt covenant. So when you are borrowing, it's either debt or equity. So we will address both to prolong our answer because obviously we want marks. Company can borrow money via debt, but it's mentioned that Kampai is close to breaching its current debt covenants. So raising further debt might also be a problem. And even if company manages to raise more debt, it will be the higher cost of capital, leading to high interest payments and low profits and dividends that may be unacceptable to shareholders of Kampai. Now you see that from just this information, it has given us 7 marks requirement. So I have to give as many points as come in my mind. Okay. That financial issues are there. Minimums per cash resources. They're offering 8 per share. They want 25% premium. So cash offer needs to be increased. One way of resolving this is to borrow. But it can borrow via debt, but it's close to breaching its current debt obligation. So this can also be a challenge because this will, even if the company raises, it will be at a higher cost of capital, increase interest, lower profits, lower dividends to shareholders. Another option for the company is to raise finance required via equity. But it's unlikely that shareholders may subscribe for equity issue, given that why shareholders won't subscribe. Because they're not getting too much return compared to Skull shareholders. After acquisition, the Kampai shareholders are not getting a very high return compared to Skull shareholders. Although there is a possibility that shareholders are convinced for finance by telling them that it is an acquisition that is of strategic importance. Okay, because in first paragraph it was mentioned strategic importance. So you can give as many points as you want, and you can increase more points as well. Not necessarily you will write my points only. And secondly, a discussion of the financial issues faced by Kampai when acquiring Kampai Cash. So I've written what are the financial issues. Okay, there was no cash. If they want to borrow, debt covenants breach. If they want to raise by equity, shareholders may not be interested. Okay. Conclude whether a mixed offer would be a better choice. Now, what is this? You haven't mentioned about this, that you need to conclude whether a mixed offer would be a better choice. See, finance director suggested that mixed offer should be considered. Everything's offering some cash, some Kampai shares to acquire Skull would be a better choice for Kampai. Now, if company is unable to raise finance via debt or equity, the only option with minimal cash is to go for a mixed offer. Now, obviously, when you don't have enough cash, you have limited cash, and you're unable to borrow. The last resort is minimal cash you have, and you can't borrow. Then the only option is to go towards a mixed offer, some cash, some shares. This might be most suitable for Kampai as utilizing the spare cash and offering some shares may result in company not having to borrow from outside sources, thereby breaching its debt covenants. And this may be somewhat acceptable to both group of shareholders, as Skal shareholders will be getting some cash as well as some shares of Kampai to ensure they remain in any future business as the shareholders, right? So when you're not able to borrow money and you have limited cash, I concluded that the best option would be to raise some mixed offer. Utilize the spare cash and utilize that extra, what you say, the cash. Okay, you can copy this. Then I will move towards, I think, the last part of this question. Okay, let's move towards the last requirement now. How Kampai's board might address the negative comments about factory closure. How Kampai's board might address the negative comments made about the factory closure. Now, this is related to Exhibit 4. We have good data. SCAL has recently established a factory producing vehicles which use hydrogen power. Kampai's board is of the opinion this factory is not financially viable, does not align with Kampai's strategic direction. It is therefore thinking of shutting down the factory once SCAL has been acquired. This closure is expected to generate immediate one-off increase in net cash flows of 42.3 million, which you incorporated here in computing value. Additional value increase of 42.3 million. Okay. An internal memo about the possible closure of the factory was obtained and published by the popular press. Resultant reaction from the media and general public has been negative. Negative reaction centers around job losses in an area which is less developed, and then this closure would be a step backwards for sustainability. Newspapers have been particularly vocal in their criticism, suggesting Kampai would be going against its core business values and destroying its reputation. Kampai's board is very concerned about this development. One director suggested Kampai should not close the factory. Another director suggested that Kampai should not proceed with the acquisition at all. Overall, Kampai both thinks these suggestions may not be viable, has asked for advice on what action can be taken to the negative reaction. So, how Kampai's board might address the negative comments. Kampai has a good reputation with investors and other stakeholders. Company is well regarded as making a positive impact on environment, also for looking after its employees. It has a good reputation. How Kampai might address the negative comments made about the factory closure. The factory, which was established by a Scow company, board of the opinion that factory is not financially viable. Kampai Sports believes that the factory established by Scow company is not financially viable and does not align with Kampai's strategic direction and plans to shut it down immediately after acquiring Skull. But this news was leaked or gone out, and now Kampai is facing heavy criticism regarding this. Company has a good reputation and is concerned about this. So one director has suggested that factory should not be closed. and other director states that Kampai should not proceed with the acquisition. Both directors' opinions seem to be extreme and not viable for Kampai. Now I have written that both directors' opinions seems to be extreme and not viable for Kampai. First director is saying not to close factory. This will result in company not getting $42.3 million, which has been considered in finding post-acquisition value. You see, this 42.3 billion is considered in finding the post-acquisition value. See, increase in cash flows due to closure of factory. And even in finding the value, we consider as 42.3. So this director's view that will result not to close the factory, will result in company not getting 42.3 million. So the whole post-acquisition value, the additional equity value created, and percentage gain for both groups of shareholders will change and may make the decision to acquire financially unattractive, right? Because he's saying not acquire the factory. Okay, 42.3 million won't come. If this 42.3 million won't come, then the post-acquisition value will change, the additional value will change, the percentage gain will change, so the decision of acquiring may change. Other directors' view that don't go ahead with acquisition is also not viable, keeping in view that this acquisition is of strategic importance. So what company can do is to go ahead with acquisition and if it wants to close the factory, it can take some steps to address the negative comments. What are the negative comments of the press? Like negative comments are regarding job losses. So company can offer handsome redundancy packages. It can offer compensation, financial and non-financial, to people who are suffering from job loss, or it can offer such employees jobs and relocation to other factories. This you can do to address the negative image. That negative comments are job losses. So you can offer jobs at other places to those employees. Okay. You can also offer job losses together with job losses that, okay, your job is going. So let's relocate you to our other factories. If they are not able to relocate, offer them handsome redundancy packages. Okay, take this money. Financial, non-financial compensation, like build something for them, build a school for them, build a park for them. This is what you can do to minimize the negative comments which are centering around the job losses. As far as negative comments are concerned, company can also do a media campaign to highlight what it is doing for jobs and sustainability in other areas of the country, and their reputation should not be judged on just one factory. Although above steps to reduce negative comments may be costly, right? Offering them jobs at other places, redundancy packages, media campaigns, these steps to reduce negative comment may be costly. They are still better than not going for acquisition and not closing the factory. Okay. So this is the answer to part 6. Please note this, and our this question is over. And once you copy, we'll move towards the next question. Okay. Okay, so let's now start the next question of this Mar-Jun 2025 past paper. This is Sobet company. Previously, question number one, the 50-mark question was done. Now it's a 25-mark question. Question number two, Sobet company. The following exhibit shows the relevant information to the question. Let's start. Sobet company is planning to sell one of its office buildings and invest money from the sale in new warehouse facilities. So what is Sobet planning to do? It is planning to sell one of its buildings. Obviously, when it will sell its buildings, the money will come. Invest money in new facilities. Okay. Today's date is 1st April. Today is 1st April. Sobit expects the sale of production facilities to be completed and 54 million received on 1st August. So it will receive money on 1st August. This will need to be invested until 1st December, the date when the purchase of warehouse facilities is forecast to be completed. Okay. Now, today is 1st April. Sobit expects the sale of production facilities to be completed and 54 million received on 1st August. Okay. This will be invested, deposited until 1st December. Okay. So I've told you always that first write three things. Today's date, 1st August. Sorry, 1st April. 54 million will be received on 1st August. It will be invested. Borrowing or deposit date, 1st August. Till when? Until 1st December. Okay. So today's date is 1st April. Borrowing or deposit date is 1st August, and company is depositing money until 1st December. So it's depositing for 1st August, 1st September, 1st October, 1st November, 1st December, 4 months. Okay. It's depositing after. Today is 1st April. It's depositing on 1st August. So 1st May, 1st June, 1st July, 1st August. It's depositing after 4 months. For how long? 4 months. 1st August to 1st December. So 1st September, 1st October, 1st November, 1st December. Okay. These are the three things you must do immediately. That what is the today's date? 1st April. It is planning something to sell and money received on 1st August. This will be invested. So deposit date is 1st August. So today is 1st April. You are depositing at 1st August. So 1st May, 1st June, 1st July, 1st August after 4 months. For how long? Until 1st December. So 1st August to 1st September, 1st October, 1st November, 1st December. 4 months later, depositing for 4 months. Central bank base rate is currently 4.5%, but has been volatile. Predictions suggest central bank base rate could fall as low as 3.8% by 1st August. So Bit currently can invest funds at central bank rate less 30 basis points. Okay, so it's fine that base rate is 4.5. Central bank base rate could fall by 1st August to 3.8, and company can invest funds at central bank rate less 30 basis points. When the investment was discussed at the last board meeting, directors indicated they would like to achieve at least 4% annual return on funds invested, but that the hedging method chosen should have a limited range of possible outcomes to make cash flow forecasting more predictable. So when the investment was discussed, directors indicated they would like to achieve at least 4% return. Hedging method should have a limited range of possible outcomes to make cash flow forecasting more predictable. Hedging the transaction. Sobet's finance director is considering using futures or options to hedge the investment. So he's considering futures or options. 3 months futures, 500,000 contract size, prices are quoted in basis points at 100 minus annual yield. June, September, December futures are given. Obviously, if you are planning to invest on 1st August, you will need a future of 1st August. If not there, you will take a future of the next September. So June, September, December futures are given. Options. 500,000 contract size, 96 exercise price, option premiums are in percentage for calls and puts is given June, September, December. One exercise price is given. The terms offered on derivatives are based on central bank base rate. It can be assumed future options contract are settled at the end of the month. We all know futures are settled at the end of the month. Basis can be assumed to diminish to zero at contract maturity to constant rate based on monthly intervals. It can be assumed there is no risk, no margin requirements, all formality statements. Since the last board meeting, finance director has received a query from another director of whether over-the-counter options should be considered instead of traded options. Director would like to know the advantages of each type of option. Seems to be a straightforward question that it's planning to sell one of the buildings, invest money in warehouse facilities. Today's date is 1st April. It expects production facilities to be completed, 54 million received on 1st August. This will be invested. So today's 1st April. You are investing on 1st August. till when? 1st December. So after 4 months, for 4 months. Base rate 4.5, it can fall by 3.8, and so bet can invest funds at base rate at 30 basis points. When the investment was discussed last board meeting, directors indicated they would like to achieve at least 4% return. Okay, hedging transaction. Finance director is considering using futures or options. Okay, so we are considering futures options. So futures data is given June, September, December. Options data is given 90 size price, and premiums are given. Then the formality statement, basis diminishes to zero. They're settled at the end of the month. No basis raised. Since the last board meeting, finance director has received a query from another director whether over-the-counter options should be considered instead of traded options. The director would like to know the advantages of each type of option. Okay. So requirement A. Calculate the expected result of using the hedging methods being considered. Which hedging methods are being considered? Futures and options. Okay. Which hedging methods are being considered? Futures and options. So requirement is calculate the expected result of using hedging methods, assuming base rate falls to 3.8. You don't have to work for increase and decrease. You only have to work that central bank base rate falls to 3. So if base rate falls, results of hedging methods, futures and options. Okay, this is my requirement. Okay, now if you have to calculate the expected results of using the hedging methods, and hedging methods are futures and options, firstly, you have to make the format of futures and options. Okay, results of hedging methods being considered, futures and options. So first you have to make the format of futures and options, right? So let's just first make the format of futures and options. And I'm first making the format of futures. So in futures, there is a strategy. First, it's this is from the notes, right? And you must learn it for the exam. It's a deposit case, so buy now, sell later. The deposit case, so buy now, sell later. And there's a strategy. Number of contracts, basis risk, unused basis. And fourth is future closer price in both cases. There is no two case. There's just one case. Future closeout price. And there's just one case. Decrease by 3.8. Decrease to 3.8. It's not like that given in the question, increase by 0.5, decrease by 0.5. Okay, it's decreased to 3.8. So you are, I think, fairly understanding it, that current base rate is 4.5 and it can fall to 3.8. That means it's basically decrease by 0.7. Okay, in the previous questions, it used to be like this, that find outcome of the H if LIBOR increases or decreases by 0.5, increases or decreases by 0.6. Here it's not increase or decrease by this. It's saying that one case LIBOR decrease to 3.8. So LIBOR base rate is 4.5, decrease to 3.8 means it's the case of decreasing by 0.7. Then tick size. Outcome of hedge in case of LIBOR decrease. There's only decrease case here, not increase. How to get the outcome of hedge? We do actual cost of borrowing or actual return on deposit. Okay. And then gain loss due to futures, net benefit or cost. It's a deposit case. So net benefit. And finally, we do the effective interest rate. The formulas of all these are given, so I will just apply them systematically to know that how things will move forward. Okay, so we have written the format of futures, and now we will start working. Okay, now we have the format, and let's just do it in the question. So the question was that calculate the expected results of the hedging method. So hedging method was futures and options. Okay. So expected results of the hedging methods, assuming rate falls to 3.8. Now, the scenario was that company, it's 1st April today, and it is investing some money, receive 54 million on 1st August. And it will be received and invested until 1st December. So today is 1st April. They are investing on 1st August for 1st December. So it's 4 months. Okay. Bank rate 4.5. It could be falling by 0.7% to 3.8%. Okay. 10 invest funds at central bank rate is 30 basis points, and it would like to hedge using futures or options. So details given. I've made the format of futures. Let's start the futures working. Okay. The first step is number of contracts. Okay. So the formula of number of contracts is borrow deposit amount over contract size into time period over 3. So borrowed or deposit amount is 54 million divided by contract size. So the contract size in the question is 500,000 into time period of borrowing 4 months divided by 3 fixed. So let's see the number of contracts. One 44 contracts. Okay. Then the next step is basis risk. So the formula of basis risk is spot minus LIBOR less futures price. Okay, so spot minus LIBOR. What is spot? 100 minus LIBOR. 4.5 minus futures price. So which future we will take? You are depositing on 1st August. So ideally you need future of 1st August. But since future of 1st August is not given, you will take the next one, that is September. So it's 96.04, right? You're planning to deposit on 1st August. You need future of 1st August. Not given, take for September. Okay. So this makes it spot minus LIBOR less futures price. 0.54. Okay. Then it goes towards unused basis basis risk over extra months upon total months. How do you get the extra months? Okay, you wanted to deposit on 1st August, right? So you needed a future of 1st August, but you took future of September with September 30th. So how many extra months? 1st August was needed. I took off 30th September. So 1st August to 1st September, 1 month, and then 30th September, 2 months. You took 2 extra months. Okay. Extra months over total months, right? See, extra months over total months. So extra months are 2. You needed to deposit on 1st August, so you needed a future of 1st August. Ideally, you should have taken the future of 1st August, but it was not there, so you took off 30th September. That's 2 extra months. And I told you total months are counted from today's date till the future date. So today's date is 1st April. And you took the future of 30th September. So 1st April to 1st May, 1st June, 1st July, 1st August, 1st September, 30th September. That's 6 extra months. This will become 0.18, I think. So I've done the 3 steps. First step is number of contracts, borrowed deposit amount, over time period. Sorry, over contract size into 4 months, time period of borrowing over 3. Basis risk spot minus LIBOR, less futures price. So you took future of September. Unused basis risk 0.54 into extra months. So you took future of 30th September. You were depositing on 1st August. So you needed a 1st August. You took of 30th September. 2 extra months. Total months, today's date, 1st April to 30th September, 6 months. Okay. Okay, now pay attention. The 4th step is future closeout price. In both cases here, there are not 2 cases. Future closeout price in both cases. No, there's just one case, decrease. It's spot minus LIBOR, less unused basis. Okay, if declining trend in basis risk. Okay. So it's spot minus LIBOR, less unused basis. So what is the spot minus LIBOR? Spot is 100. LIBOR. Now LIBOR is not 4.5. It's the case of decrease to 3.8. Okay, so LIBOR is 3.8 here. 96.2. Unused basis. 0.18. So this makes it 90. Six point 02. But this is the thing which you are trying to do in rote learning. Okay. And if you do rote learning, then obviously you will suffer. Okay. Now what's the problem here? See, spot minus LIBOR, less unused basis if declining trend in basis risk. Spot LIBOR had unused basis if rising trend in basis risk. Okay. Now what is the trend here in basis risk? The trend seems to be rising here. Okay, the trend seems to be rising here, as well as basis risk. Spot minus LIBOR, less futures price. Okay, so if you do spot minus LIBOR, 100 minus 4.5, 95.5. Okay, and futures price is 96.04. It again sees a rising trend, right? If spot minus LIBOR is 100 minus 4.5, 95.5, and futures price is 96.04, it suggests rising trend. Okay. So since it's a rising trend, so spot minus LIBOR, not less unused basis, but add unused basis. Okay. $96.38. Now, many of my students who would be doing this question, they would have made it maybe 96.02 because they're trying to rote learn that in the class past papers, it's always deduct unused basis. Yes, in the past papers, unfortunately, many past papers that have been tested before, it was always a declining trend, so always unused basis. But if you look at the class lectures, I think it's clearly mentioned that for future closer price, spot minus LIBOR, less unused basis if declining trend in basis risk, spot minus LIBOR, add unused basis if rising trend in basis risk. If you look at the basis risk, step 2, It's spot minus LIBOR, 100 minus 4.5, had 95.5, had the futures price. Okay, been 95.4. I would have said, okay, spot minus LIBOR 95.5 and future price is 95.2, declining trend, unused basis. But here it's spot minus LIBOR 95.5 and futures price is 96.04. It seems a rising trend. Okay, so you need to add it. Many people also don't want to learn two things, less unused basis, add unused basis, trend. They want to rote learn things. So for them, if you remember like this, that it's less unused basis, for example, just for a concept. Okay. Then you see it's 100 minus 4.5, 95.5 less 96.04. This will be negative 0.54. Okay. 100 minus 4.5, 95.5 less 96.04. It's negative minus 0.4. And the unused basis will also come in negative. Okay. And if you do spot minus LIBOR 100 minus 3.96.2 less unused basis. So less unused basis means minus the unused basis, which is negative 0.18. So mathematically, it would also become 96.38 minus minus becomes plus. Okay. But I don't want you to rote learn things. Okay. Even though if you only remember less unused basis, if unused basis is going to come in positive. So 96.2 less 0.18, positive 0.18 less, it's 96.02. Whereas if you're just learning less unused basis, 100 minus 4.5 less 96.04, if it's negative, so 96.2 less the negative 0.18, it again becomes 96.38. But conceptually, it's basically rising and falling trend. So no need to mention the signs. It's just like that if 100 minus 4.5, 95.5 is the spot minus LIBOR and futures price is 96.04. It's rising. Okay, so it should be added 96.38. Okay, then tick. So is the tick given? No. So find the tick. What's the formula of tick? Contract size into 1 upon 10,000 into 3 by 12. So contract size is 500,000 into 1 divided by 10,000 into 3 by 12. Right? 500,000 into 1 upon 10,000 into 3 by 12. Okay. 5 steps. So let's just quickly recap the 5 steps. The first step of futures was obviously it's a deposit case. So as per the format, deposit is buy now, sell later. Okay. Then today's date is 1st April. We are planning to deposit on 1st August till 1st December. So it's 4 months. Okay. Base rate 4.5 can reduce by 0.7 to 3.8, can invest at central bank rate less 30 basis points. Okay. And recommend calculate the expected results of hedging methods. Okay. You don't have to recommend now, just calculate the results of hedging. Okay. Being considered. So the considered methods are futures as well as options. Okay. So let's start calculating the expected results of futures and options. So for futures, I made the format that the first step is number of contracts and basis risk, unused basis, future closer price. In both cases here, it's just the decrease case 3.8. Tick size, outcome of hedge, and effective interest rate. So number of contracts was borrowed or deposit amount, that was 54 million, divided by contract size, that was 500,000. Into 4 months, the time period of borrowing over 144 contracts. Okay. Basis risk was easy. Spot minus LIBOR, 100 minus 4.5, less futures price. So since you have to deposit on 1st August, you will be needing a future of 1st August. Not available September 30th. So you're taking of September futures. Okay. So it's 96.04.54. Unused basis, it's spot minus LIBOR sorry, futures basis risk is spot minus LIBOR less futures price, and unused basis is the basis risk. 0.54 extra months over total months. So I've told you how do you get extra months. So you had to deposit on 1st August, you need future of 1st August, but you took off 30th September. So 2 extra months. Total months, today's date, the 1st April till the 30th September we have taken. So 1st May, 1st June, 1st July, 1st August, 1st September, 30th September. Okay. Unused basis. Then future for the price, spot minus LIBOR. Since it's the case of decrease by 3.8.7 to 3.8, so spot minus LIBOR. LIBOR is not now 4.5. In this decrease case, it's 3.8. Less unused basis, if declining trend, add unused basis is rising. Okay, so here it's spot minus LIBOR, 100 minus 4.5, 95.5. Okay, and 96.04, so it's 0.5 for rising trend. I can also elaborate it here that basis risk which I used to compute in the classes, in the way of classes, that it's spot minus LIBOR. So it's 100 minus 4.5 less futures price. 96.04. Okay, so you can see that the trend is rising by 0.5. Okay, and if it's rising trend, I will add it and use sources 0.1 at 96.8. I would just try to make this concept more clear to students, specifically those who have studied from me, because all of you who are watching these lectures from LMS, they have studied from me. But many people, for them, we upload these past papers on YouTube, so they might have not studied from me. Just for recalling, and this will be captured more by my students. You know, after doing this format, you can open your notebooks as well to check this. We did the first question of Avan company. Now remember, in Avan company, Avan is expecting to receive 48 million on 1st Feb, which will be invested. So it's a deposit case of you investing on 1st Feb. Okay. So if you have to deposit on 1st Feb, you might be needing the future of 1st Feb, but future is available for March. So you took off March. Okay. Now please open your notebooks if you are unclear with this concept. So in Avan question, what did I do? Spot minus LIBOR. Here the LIBOR was 4.09. Here the LIBOR was 4.09. Okay. So in Avan, what I did was spot minus LIBOR. That was 100 minus 4.09 in Avan question. LIBOR, spot minus LIBOR. And the futures was of March, because you wanted to deposit on 1st Feb, you need the future of 1st Feb, but it was for 30th March. Next month, next future. We took a future of 94.76. So basis was 94.76 spot minus LIBOR as futures. 95.91 minus 94.76. 1.15, and see, it was falling 95.91, 94.76. So the declining. So in the next step, if you look at this question, we decrease the unused basis. Okay. In Avan, we decrease the unused basis, but this is not relevant for you. It's just for recalling. Okay. In this question, spot minus LIBOR, it's 100 minus LIBOR is 4.5. So 95.5. Future prices for 1st August deposit, you took future of September. 96.04. It's a rising trend, and if rising trend, I will add the unused basis. Okay, so I hope it's clear. Then tick size 500,000 to 1 upon 10,000 into 3 by 2. Outcome of hedge in case of LIBOR decrease. Okay, actual return deposit. What is the actual return? Now what did the company do? Actual return on deposit can also be computed. Amount into interest rate into time period overdraft. So amount into interest rate. What is the amount? 54 million into interest rate. What is the interest rate? you will deposit money at 3.8%, less 30 basis points. Okay. Amount into rate of interest. You won't be depositing deposit if return on deposit in case of LIBOR decrease. Now LIBOR is decreased to 3.8. You will get 3.8 less 30 basis points into time period 4/12. So let's see how much is 630,000. Then gain or loss due to futures. How do you get gain or loss due to futures? Difference in futures price and futures solar price into spot into number of contracts into. So futures price and futures lock-in rate. So difference in futures price. What is the futures price? 96.04 into the September futures and future lock-in rate. What is the future lock-in rate? Future closeout price 96.38. Difference in futures price 96.04 and future closeout price 96.38 into spot into number of contracts into spot into number of contracts into tick. $61,200. Very important question. It's a gain or loss. Okay, because it's a gain, it will be added in the return. If it's a loss, it will reduce our return. Okay. So difference in futures price and future closeout price, pay attention. It's a buy now, sell later. So buy now 96.04, sell later 96.38. Buy now 96.04, sell later 96.38. Now if buy now 96.04 and sell later 96.38. Buy at 96.04, sell later 96.38. Is it a gain? Yes. So gain will increase our return. Add it. Final answer will be 691,200. And finally, the effective interest rate. Net cost return over borrowed deposit amount. Net cost return over borrowed deposit amount into 12 months over time period. So 12 months over time period 4. (3.84% if we convert it into percentage. Okay, this is our effective interest rate. And this is the future. You don't have to recommend anything. As per the requirement, we just have to calculate the expected results of the hedging methods. So expected results of futures is in front of you. Okay. I will suggest you to please copy this, the expected result of futures, so that I can then move forward. Okay, this is in front of you, so please copy so that I can move forward. Okay, simply the number of contracts and the basis risk of minus LIBOR less futures price. Since it was a rising trend, C 95.5 to 96.04. Therefore, I added any basis. Had it been a declining trend, like previous questions, we always used to deduct it. Okay, take outcome of hedge, actual return, gain loss due to futures, buy now, sell later at a higher price, gain, and then effective interest rate. Okay. Now the requirement was calculate the expected results of hedging methods being considered. So I just have to find the expected results of hedging method being considered, that is futures and options. I've done this for futures. Now I have to do this for options. Okay, let's make the format of options. It's deposits of all option. There is no case one, case two, only case one, liable decreased 3 point. Only case. So we have the format, hits depth, excess price, future pattern, future exercise, yes, no, gain, response, total gain, actual cost of borrowing, attributable to our premium payable, net cost of activity. Okay, let's start. So borrowing or return, non-deposit, premium payable, net cost or net return, effective interest rate. Okay, these are the things. We have made the options format. Let's start. Okay, so what is the exercise price of option? Only one price, 96 is given. Right, 96. Future closer price from futures. We have calculated the future closer price from futures. 96.38. Okay. Exercise, yes, no. So we have to decide exercise, yes, no. You know, it's the strategy of buy now, sell later. So buy now, sell later, means buy now, sell later. Again, yes. Gain in basis points is yes, it's 0.38, 38 basis points. Okay. Total gain. Let's calculate total gain. Gain in basis points, number of contracts taken. Gain in basis points, number of contracts. Option will also have 500,000 contracts, so the number of contracts will be the same. $68,400. Okay. Actual return on deposit you have already calculated. 54 million into that 3.8 minus 30 basis points, 3.5 into 4 by 12, 630,000. Finally, premium payable. Premium payable, then we will decide to add or less premium rate into spot number of contracts. Premium rate, spot number of contracts. Okay. Premium rate. Which premium you should take here? You are going to take call option. And 1st August deposit means take future option of 1st August, not available, so take for 1st September. Okay. Sorry, September. September future, 0.193 call. So premium rate is 0.193 into spot number of contracts. Spot number of contracts. Okay. Okay. Which to add, which to debt. Okay. This is a gain. Gain will increase our return, so add it. Gain will increase our return, so add it. 630,000 at 6400, but premium has to be paid. It will reduce our return. Deduct it. Okay. So 630,000 return, add the gain minus the premium payment. Net return. Okay. Effective rate. Net 663,660 divided by 54 million into 12 over 4, 3.687%. That's it. You have calculated the results of hedging methods being considered. You don't have to recommend, just calculate the results of hedging method. This is it. Please copy the options as well, right? Okay, so once it's done for calculate the results of hedging method, there was no recommendation. We did just the results of hedging method. So once I have given them the results of hedging methods being considered, Part B, discuss whether futures or options should be recommended. Now you have to discuss what should be recommended or whether Shobet should consider any other choices. So it's a 5 marks requirement. I have to discuss whether futures or options shall be recommended or whether should consider any other choice. It's a deposit case. So effective rate is this in futures, this in options. So obviously it should prefer futures, but let's just discuss which should be considered. Okay. The effective interest rate of futures was 3.84% and effective interest rate of options was 3.69%. Although you just have to make sure that you give recommendation considering there are 5 marks. And you have to decide first between futures and options and recommend any other option as well, because or whether it should consider any other choices. I have some other choices as well. So I'll make a 5 mark answer. Although options do provide flexibility that company can exercise option if in benefit or let it lapse if it is giving loss. The financial return of options is worse than futures since it is a deposit case. Company will prefer futures over options. Options prove more expensive, mainly due to higher premiums involved. So I have given this answer, discuss whether futures or options should be recommended. Okay, so since options have high premiums involved, they give flexibility, but they have the premiums, it's giving less in deposit. Okay, so for towards futures, I've recommended. Whether someone should consider any other choices. However, before taking final decision between futures and options, company can consider some other hedging choices. What are the hedging choices? We have 2 more, subs and FRS. Company can consider FRA, which locks a rate for future transaction and is usually cheaper than other options. Or company can consider a collar as well. They can consider FR, they can consider collar. One thing which you can mention here is that see here, this is what you call, you should be alert with the question. When the investment was discussed, directors indicated they would like to achieve at least 4% return on the funds invested. Okay. Directors wanted a 4% return Both hedging methods are producing less than 4%. So it's important to consider that even though futures is better, company must consider other hedging methods before taking final decision. Okay, so you can copy that recommendation as well as whether other methods shall be considered. Maybe 2.5 marks for recommendation and 2.5 marks for other methods ideal. Okay, last part. Let's move to the last part. Compare and explain the advantages of swap using over-the-counter options versus traded options. So just the advantages of over-the-counter options versus traded options. Before answering this part, this has come up multiple times in past paper. The main difference between traded options and over-the-counter options are both options. But traded options are traded in financial markets. They are available in financial markets. Okay. Over-the-counter options are tailor-made. You can go to someone and make an option for yourself. The maturity date, the amount, the contract size. Okay. So traded options are usually available readily in financial markets. They have established contract sizes and maturity periods. And these things cannot be negotiated. Okay. In contrast, over-the-counter options are tailored. A company can negotiate the contract size or the maturity period. Okay. Like for example, I go in the market for options. They say that 3-month expiry, 100,000 contract size. I have to take it in traded options. Okay. Because that's what the market says. 100,000 contract size, 3 months expiry, or 200,000 contract size, 4 months expiry. I have to take it. It's pre-established in the market. Over the counter options are tailor-made. You can go make the option, negotiate the contract size, negotiate the maturity period, like what is happening in many questions. You want an option of 1st June. That's not available in the market. You go for 30th June. In this question, you have to deposit on 1st August. You need option of 1st August. It's not available. So you have to take off 30th September. This is what the market states trading. Over the counter options, you can go and negotiate, make your own contract size, make your own maturity period. Okay. The main advantage of OTC option is its flexibility. That company can acquire option of its own wish, unlike traded option, which have no flexibility to make on their own. However, traded options do carry more protection than OTC option because of more regulation of financial markets. Hence, company is more protected. Over the counter option, you go and take tailor-made from anyone. Traded options available in the financial market. So they carry the regulation of financial markets. That's more safe compared to OTC. Since traded options are available in markets, they are more transparent in terms of pricing, as everyone gets same price. Tailor-made. I'm going negotiating with someone. He's giving other price to me, some other price to someone else, some other price to someone else. But in trading option, there are markets, no negotiation. So everyone gets the same price. So usually it's more transparent compared to that, what do you call, OTC option. Okay. Because on OTC option, what is happening that I'm going and negotiating tailor-made. I might get some other price, someone else might get some other price. But traded options have financial markets, so everybody gets the same price. Okay, so you can copy this. Our question is over. Question number 2, the risk management, the hedging. Okay, and after this, we will move towards the question number 3. Okay, please copy this. Okay, let's now start the question number 3 of this Mar-Jun 2025 past paper question. We have solved question number 2 recently. Now it's question number 3's time. This is Grand Railways Company. Following exhibits available on left-hand side provide information relevant to the question. Okay. The rail network of the country of North Asia is divided between maintenance of rail tracks and operation of trains and stations. So rail network in the country of North Asia is divided between maintenance and operations. Single company owned by North Asia central government is responsible for maintenance of rail tracks. The operation of rail services and station is divided into a number of franchises. Franchises are operated by shareholder-owned companies, with some companies operating more than one franchise. Franchises are awarded for a specific number of years. The revenue from franchises is mainly derived from ticket sales from rail journeys. Okay, please understand the scenario. A rail network in North Asia is divided in two segments. One, maintenance of rail tracks, another, operations of train. Any rail network involves two things, like airline involves two things, maintenance of aeroplanes and operations, flying. So rail network of this country is divided into maintenance of tracks. One part is maintenance of tracks, another is the operation of trains. Okay. Single company owned by North Asia central government is responsible for maintenance of rail tracks. All rail tracks maintenance is done by North Asia's single company. Central government is owning that. Operations like tickets and running of trains. This is divided into a number of franchises. Franchises are operated by shareholder-owned companies, and some companies operating more than one franchise. Franchises are awarded for a specific number of years. How do franchises earn income? Ticket sales. So, the rail network is divided into these two. One is maintenance being done by the central government, and operation is done by different franchises. And franchises sell tickets to earn revenue and then do the operations. The two biggest companies involved in operating rail services in North Asia are Grand Country Railways GCR and City and Town Railways CTR. So there are two companies in operations. The maintenance is done by one company. Central government owns that. Other operations are done by two companies. So two biggest companies in operations are Grand Country GCR and CTR. Rail services operated by GCR and CTR each include services into one of North Asia's biggest cities, which passengers use to get to work, and service covering other areas where there is significant leisure and tourist travel. So both companies include services into biggest cities so that people can travel to work, and tourist areas. The most important distinction in ticket pricing for both companies is that most expensive fares are charged to passengers going to work in the morning and coming home in the evening, and cheaper fares are charged at other times when services are less busy. That's quite normal that they charge expensive fares while going to work and coming back from work because it's the rush time. Okay. But in between, when the services are less busy, less fares are charged. North Asia's government has insisted for the last 2 years that the rail fare should remain unchanged, but will allow rail companies to raise prices over the next year. So government has insisted that fares should remain unchanged, but will allow prices to increase over the next year. Over the last few years, there have been an increasing number of complaints by passengers about GCR service. GCR trains are older on average and break down more frequently than those operated by other companies. GCR's percentage of trains cancelled is also higher due to tighter staffing policies, meaning there are no spare staff available to operate scheduled trains if staff are absent. Passengers have also complained about the lack of staff available to help the stations operated by GCR, poor state of facilities at GCR station. In response, North Asia's government notified GCR last month that one or more of its franchises may not be renewed when they end, unless GCR invests in up-to-date trains, cancels fewer trains, and enhances facilities at the stations with operates. So it's a scenario that rail network in North Asia is divided into maintenance and operations. Maintenance is done by one single company, which is run by central government. Operations have been done by two companies, three companies, four companies. They're given franchises. They collect revenue from ticket sales and run operations. Two biggest companies are GCR and CTR. Rail services at GCR and CTR include city travel as well as tourist places travel. They do pricing distinction. Expensive fares are being charged at morning and evening time when people are coming and going to work. When less busy, less fares. Government is saying fares should remain unchanged and it will allow prices to raise over the next year. Over the last few years, there have been increasing complaints by passengers about GCR's train service. And GCR trains older, breakdown, they don't have staff, conditions and facilities are not good at stations. Government has notified GCR that their franchises will not be renewed unless they invest in up-to-date trains, cancellation is low, and facilities are enhanced. In the next exhibit, this was the first exhibit here. Okay. In the second exhibit, GCR, performance data is given. So revenue of GCR 2002, 2490 million, then 2555 million, 2612 million. For 3 years, revenue is increasing. Operating profit double to 50. Sorry, operating cost double to 50, 2346, 2427. Costs are also increasing. Profit 240 million, 209 million, 185 million. Profit is falling. Revenue is increasing. Costs are also increasing, but profit are falling. Finance cost 64 million, 5650, it's falling. PBT 176, 153. PBT is also falling. Tax 34, 31, 28. So PAT 142, 122, 107. Declining trend. Dividends have remained stable. This is 3 years profit and loss statement. Balance sheet. Non-current assets, note 1. Non-current assets consist of land and buildings, trains, plants, and equipment. So non-current assets 1240, 1230, 1225, they've remained same, and they include land and buildings, trains, plant, and equipment. Current assets, bank and cash 521, 485, 430. Bank and cash balance falling. Other current assets also falling. So total assets 1940, 1880, 110. Profits, total assets are falling. Equity 200, 200, 200. Company hasn't issued more shares. Reserves have increased. Total equity 645, 705, 749. Total equity has increased due to increase in reserves. Non-current liabilities falling. Okay. Non-current liabilities falling. Non-current liabilities falling. The debt 900, 800, 700. The non-current liabilities are falling. Note 2. So non-current liabilities are falling. Note 2. Non-current liabilities consist of loan notes redeemable in 5 years, market value equaling nominal value, bank loans repayable in installments. So they include loan notes, market value and par value is falling. Market value and par value, sorry, same. So it's 900, 800, and 700. Current liabilities include trade and other payables, 361, 344, 333. Taxation. So current liabilities are also falling. Total equity and liabilities are falling. Market price per share 8.93, 8.22, 7.56. Price per share is falling. Other data. Other data states passenger journeys 216 million journeys, 229, 243. Journeys in millions is rising. Journey length, kilometers traveled in millions, is also rising 8200, 89, 20, 9700. When we will discuss the question in detail, we will focus them on detail. Customer satisfaction 73%, 71%, 68%. That is also falling, but journeys is rising. And the same data is given for CTR, but not the balance sheet. I think only the profit and loss statement of CTR is given. Revenue rising, not like GTR. Operating profit rising. Operating profit margin percentage slightly falling. Gearing 34.02, 34.23, 34.44. It's almost same, no 3. Gearing is measured on market value basis, debt over debt plus equity. So it has cleared you, gearing is not debt over equity plus, in fact, it's debt over debt plus equity. Okay. And after the gearing, it's remaining stable. Then market price per share, very higher than GTR. The GTR's market price per share was lower. See 8.93, 8.22, 7.56. It's higher and almost stable, slight fall. Passenger journeys in millions, it's also higher, okay, than CTR. Length in journeys, kilometers, it's also higher than GTR, except this year. And customer satisfaction percentage is 85, 86, 86%. Okay, so this is all the data. Satisfaction percent is also higher. Now, after all this data, what is the requirement? Evaluate GCR's performance and financial position. Your answer should include both company and investor perspective. You should indicate in your discussion any omissions in the data provided where further information would be helpful to extend your analysis. Provide relevant calculation for ratios and trends to support your evaluation. 10 marks are available for calculation. Out of this 20 marks question, 10 marks for calculations and remaining for discussion. Okay. So you need to evaluate GCR's performance and financial position. You don't have to evaluate CTR's performance, only evaluate GCR's performance and its financial position. Your answer should include company as well as investor perspective. So evaluation should be from company as well as investor perspective. You should include in your discussion any omissions in the data provided where further information would be helpful. You should write If further information is needed to extend your analysis, provide calculations and trends, 10 marks for calculations, 10 marks for discussion. A very easy, very unexpected, very good question of performance measurement. We will start solving it. Okay. Okay, so many people basically ask me that whether ratios and performance measurement is important. Yes, sometimes it can come up, and trust me, it's a very mark scoring question, right? That you have to evaluate financial performance and financial position. Should include both company and investor perspective. Now you need to evaluate performance from company's perspective as well as investor. You should indicate any omissions in the data provided. Further information would be helpful to extend your analysis. You should write that this information would have been more helpful for me. Ratios you need, trends you need, 10 marks are available for the calculation. So let's just quickly give it a thought again. That the rail network of North Asia is divided into maintenance and operations. Okay, so there are two things, maintenance and operations. Single company owned by central government is responsible for maintenance. Operation is divided into franchises. Two biggest companies in operations are GCR and CTR. Rail services operated by GCR and CTR include transport to bigger cities and tourism areas. Price distinction is there. Expensive fares are charged for morning and evening, and less fares at less busy times. Government has insisted that fares should remain unchanged. Last few years, increasing number of complaints by customers about GCR train services. GCR trains older, break down more frequently, percentage of trains cancel is higher, no spare staff available. Passengers have complained about lack of staff available to help at stations, poor facilities. In response, GCR has been notified by government that unless you improve, we won't renew your license. Okay. Now, data of GCR is given then revenue, operating profit, operating cost, finance cost, PBT, tax, PAT, dividends, balance sheet is given. We have read them, and the city town railways, some ratios are given. Revenue, operating profit, operating profit margin percentage, gearing, market price per share, passenger journeys, length, customer satisfaction. Okay. And requirement is evaluate performance and companies and impact perspective. Your discussion should include anything which you consider would be more helpful. So 10 marks for calculations. Now, let me tell you one thing, that obviously you need to evaluate performance, and for that you need ratios. 10 marks are available for calculations. Remember one thing. If 10 marks are available for calculations, so every ratio is worth 0.5 marks. So for 10 marks, you need to compute 20 ratios. For 5 marks available for calculations, 10 ratios. For 8 marks available for calculation, 16 ratios. So there are 0.5 marks per ratio. Obviously, you know that if you want to evaluate performance, you need to find ratios first. So 10 marks are available for calculation. Let's find ratios. Since 10 marks are available for calculation, at least 20 ratios. Okay. So my first target is to find 20 ratios. And I can get many ratios from the data. Like I can get percentage change in revenue. Now, I am asking about 20 ratios. Whatever I am computing, it's not necessarily you also have to compute the same ratios. You can compute some other ratios and evaluate on that. It's perfectly fine. No need to focus on this point. Oh, sir has done these ratios, so I should also do this. No. It's your choice, your discussion, but 20 ratios need to be there. So percentage change in revenue. 2004. I can compare with 2003 to get it. 2003. I can get it. But obviously for 2002, it won't be possible because previous year's data is not available. So let's find the percentage change in revenue. It's just the difference of revenue from 2004 to 2612 and 2555. And 2003, it was 2555 and then 2612. 57 is the increase. The base or starting point is 2555. Its difference, 2612 and 2555 over the base starting point, 2555. 2.2%. And then from 2003 to from 2555, sorry, 2490 to 2555, difference is 65 over the base of starting point 2490, 2.6%. For 2002, there is no 2001 data, so I cannot find the percentage change in revenue. Then percentage change in profit. So let's find the percentage change in profit. From 209, it became 185, fall 24, divided by base 209, 11.5% negative. And what about this? It's 209 from 240. So the fall is 31, divided by the base starting point 240, 13%. Okay, so profit is falling by 14 and 923, divided by base starting point 209. And secondly, it's falling by 31 divided by the base starting point. Okay. 31 divided by 240. So it's 12.9, 13%. Okay. Then you can get operating profit margin percentage. It's operating profit over sales. So 185 divided by 2612. Then 209 over 2555. And then 240 over 2490. Okay. Then it's interest cover. It's PBIT over interest. So PBIT before interest and tax is 185 over 50. 209 over 56. 240 over 64. Okay. See, people were saying 20 ratios would be very lengthy. See, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I've got 10 till now, so it's not that long. So from profit and loss account, you've got change in revenue, change in operating profit percentage, interest cover. Anything you can use about the balance sheet, you can find the rows. It's PBIT over capital employed over 100. So PBIT, it's 185 over capital employed. It's total assets 1810 less current liabilities. So total assets 1810 less current liabilities. 361. PBIT over capital employed. Capital employed is total assets 1810 less current liabilities 361. I think it's going to be 1449. Or you can also find the capital employed as debt plus equity. Was debt not debt, non-current liabilities. Debt plus equity. Non-current liabilities is 700 plus equity is 749. So still you're going to get 1449. Capital employed. Total assets for 2004. Total assets is 1810 minus current liabilities, that is 361. You get 1449. And capital employed can also be found by debt plus equity. So what is debt? The company's non-current liabilities. So non-current liabilities are 700 plus equity right above that is 749. So both give the same answer. Then for here, it's PBIT. What is the PBIT? 209 divided by capital employed. That's total assets less current liabilities or debt plus equity. 1880 minus 375. And then PBIT, profit before interest and tax, 240 upon total assets less current liabilities. Total assets minus current liabilities, 395. Then you could get asset turnover. Sales over capital employed. So sales are 2612. Capital employed is 1449. Here sales are 2555. Capital employed 1505. Here's sales over capital employed. So capital employed is 1545 for this year. Sales are 2490. Okay, so we have got gross and asset turnover as well. What else can you capture here? Let me just convert rows into percentages. I think we can get current ratio here. So current assets is 585 and current liabilities 361. Okay. $650 over 375 and current assets 700 or current liabilities 395. I've got the current ratio. It's looking a bit messy, so I'm trying to stop it to two decimal places. Okay. Then we can have the gearing. Remember, it's clearly mentioned in the question that gearing is Non-current liabilities, debt over debt plus equity. So make sure you do not debt over equity plus, or in fact, debt over debt plus equity. So what is the debt? Non-current liabilities, 700 over 700 plus equity is right above that, 749. Or the next year, that is 800. So let's just calculate it again. Just a second. That is 800 over 800 plus equity. Okay, one thing which I need to change here is that I have computed gearing debt over debt plus equity, but I've taken the balance sheet values, which is book values. Okay. It says gearing is measured on a market value basis, debt over debt plus equity. So now it's debt over debt plus equity, market values. Okay. So let's just understand this point. 2004, 2003, 2002. Okay. So let's just find the debt market value and the equity market value. So debt is mentioned as non-current liabilities consist of loan notes redeemable in 5 years' time. Okay. Market value equals book value. So market value equals book value. So what is the market value of debt? 700, 900. Equity market value. Now, this is the equity's book value, 200, 200, 200, $1 par value. That means 200 shares, 200 million shares. And market value of equity is not the book value, it's number of shares into current share price. Okay, you might have studied that in financial management as well. It's number of shares into current share price, right? So number of shares into current share price. Number of shares are 200 and share price is 7.56. Okay, similarly, number of shares 200. Current share price, it's 8.22. Number of shares are 200 into share price is 8.93. Why I didn't add reserves? See, this is a concept of F9 financial management. In market value of equity, it's just the number of shares into current share price, no reserves, nothing. If you're calculating book value of equity, that's share capital, premium reserves, everything. But market value of equity is just the number of shares into current share price. So gearing is debt over debt plus equity. Debt is 700 or debt 700 plus equity 1512. Okay. For 2003, debt is 800 over 800 plus equity 1644. And that is 900 over debt 900 plus equity 176. Okay. This is what we did with gearing. Debt over debt plus equity. Don't take balance sheet values, it's book values. Market value of debt is the same, but equity's market value is number of shares into current share price. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. We've got 22 ratios. And I think no ratios are not needed because this passenger journeys, passenger length, and the market price per share, we can comment on them. Okay, we can comment on them directly rather than calculating ratios. If you want to find, you can find one more ratio, that is earnings per share. Okay, if you want, you can find the dividend per share. This is if you want to find. Okay, then there is if you have earning per share, you can find the PE ratio. Market price per share is given, earning per share found. So there are multiple options of ratios, right? Let's compute these three so that we have a good base, and then we can move towards the commentary. Okay, now earnings per share is the profit after tax. So let's see what is the profit after tax here. 107, 122, 142. Less preference dividend, it's not there. Over number of ordinary shares. So number of ordinary shares are static, 200 each. Okay, dividend per share is dividends over number of shares. 36 over 200. Number of shares and dividends are the same. P ratio is the market price per share over earning per share. So let's see what's the market price per share. 7.56. 7.56 over market price per share. What is the earning per share? You have just calculated 0.535. Okay. And market price per share 8.22. Earnings per share is 0.61. And market price per share is 8.93. Earnings per share was. Okay, so this is basically the what you call PE ratio. Now, I personally think that for 10 marks, there are too many ratios now which we have computed here. It's not just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 0.5 into 11, it's just 5.5x. No, every working is worth 0.5 marks, right? Every working is worth 0.5 marks. So 1, 2, 1, 2, 3, 3, 6, 9, 12, 15, 18, 21, 24, 27. I've got approximately 30 ratios now to comment. So I think let's start the commentary, but first you will be needing some time to copy these ratios. I would suggest you to quickly copy them so that I can move towards the commentary. Okay, now let's just start commenting on the performance of this company. And company and investor both perspective need to be taken. In the end, I will cover the investor's perspective as well. But first, evaluate the company's financial performance. Okay, let's use a word processor and evaluation of financial performance. We can do this. First, let's talk about percentage change in revenue and profit. Percentage change in revenue was 2.6% increase last year, but this year revenue has only increased by 2.2%, which is not a very good increase. You can compare this with the data provided. That if you look at the passenger journeys, so from 229, it becomes 243. So increase by 14 divided by the base 229. 6% passenger journeys increased. Okay, more passengers. Traveled kilometers from 8920 to 9700. Difference divided by base. So the passenger journeys and the passenger journey length, they are increasing by 6 and 8%. Okay. But this way your revenue should also increase because passenger journeys are increasing, but revenue is still just increasing by 2.2%. Okay. So this is a cause of concern. Even though the passenger journeys and journey length in kilometers has increased by 6% and 8%, the revenue has only increased by 2.2%, which may indicate company did not increase price due to government statement, or it wasn't able to charge high price in morning and evening shift. Further breakdown about price may be helpful in analyzing more. Okay. Revenue only increased by 2.2%, which you just calculated. Although if I check about the passenger journeys is the volume, because volume into price is the revenue. They increased by 229 to 43, 6% and 8%. Okay. If they've increased by 6 and 8%, revenue should have also increased. It's increasing only by 2.2%, which means the volume has increased. The company was unable to increase the price either due to government, or they were unable to charge good fares, high fares in that morning and evening shift. So further breakdown may be good. You can also compare it to CTR because CTR data is given 2795 to 2920. So you can write CTR's revenue has grown by 4.4%. If we compare this revenue and passenger increase with CTR revenue has increased by 4.4% and passenger journeys by 4.7%. Okay, if you compare it with the CTR, revenue has increased by 4.4%, but passenger journeys by 4.7%. This means GCR was able to generate more passengers than CTR, but it was unable to increase revenue like CTR. So pricing seems to be affecting our revenue. Okay. Our passenger numbers were more. Their passenger increases were only 234, 245, 4.7%. Our passengers was 229 to 243. They grew more by 6%. So we captured more passengers, but revenue we were unable to increase compared to CTR. So pricing seems to be an important factor in this. So I think we have done a good analysis on this revenue thing. Okay. We compared with revenue with our passenger journeys as well. And we compared our revenue with CTR as well. Okay. You can also talk on the other ratios like profit. Okay. Our operating profit margin is falling and profit is falling. Okay. And CTR operating profit margin is higher than us. And its operating profit is also rising. Okay. From 273 to 282, whereas our operating profit is falling. See, our operating profit is falling. Their operating profit is rising. And our operating profit margin is also lower than them. So let's talk about this. Even though company was slightly able to improve revenue, it should have increased operating profit, but operating profit has fallen by 11.5%, indicating issues in cost control. If your revenue is rising, your profit should also rise. Since profit is falling, operational issues in cost control. Operating profit margin has also fallen from last year, and compared to CTR, our operating profit margin is lower than CTR2. CTR is also able to increase its operating profit from last year, whereas GCR's operating profit has fallen. So cost control seems to be better at CTR. Okay. I think we have addressed this profit margin point as well. Okay. And operating profit margin. Then I should comment on interest cover because obviously whatever ratios I have computed, I have to comment on them. So now let's just comment on this interest cover. Interest cover seems to be stable. So let's just look at the data. PBIT has fallen, so interest cover should fall. But finance cost is also falling, mainly because the company's non-current liabilities are falling. Note 2, non-current liabilities are loan notes, market value equals nominal value, bank loans, repayable installments. So since you're paying off installments, so non-current liabilities are falling, which is leading to fall in finance cost. That's why interest cover is stable. Although your profit is falling, PBIT is falling. So your interest cover should fall. But since finance cost is also falling, PBIT is remaining stable. Interest cover is remaining stable. Interest cover is almost stable each year and does not seem too worrying. Although PBIT has fallen, which should have reduced interest cover. Finance cost has also fallen due to repayment of some loans. Hence, interest cover is not that affected. So we have talked about interest cover as well. Okay, now after interest cover, let's see what we have to talk about. Okay, now you have to talk about the return on capital employed and the asset turnover. Return on capital employed is seen falling since last 2 years. Return on capital employed is seen falling since last 2 years. From 15% 2 years ago, it now stands around 12%. Why it is falling? So obviously it's because your operating profit, the PBIT is falling. This is due to fall in operating profits because the formula was PBIT over capital employed. So this is fall in operating profits. If you look at capital employed, capital employed has fallen because debt is falling. So capital employed has fallen. Even though capital employed has fallen, the denominator, capital employed has fallen, which should have increased ROS, still fall in profits are resulting in fall in rows. Asset turnover has risen mainly due to decrease in capital employed denominator and slight increase in sales. Asset turnover is sales over capital employed. So sales have slightly increased since profits decrease, so rows decrease because numerator of rows is profit. Numerator of asset turnover is sales. So if sales have increased and the denominator capital employed has fallen, this has resulted in increase in asset turnover. Current ratio. Current ratio seems to be on a safe position, although there is a small decline, but it's not worrying as company still has enough assets to pay off its liabilities as they fall due. Okay, current ratio has slightly fallen, mainly due to, I think, a slight fall in current assets. Bank balance, other assets, slight fall in current assets. You can write this in the reason as well. Due to decline in current assets. Okay. Gearing has fallen now. Gearing can be compared to the CTR as well. CTR's gearing is 34. Ours gearing is less. So why gearing is fallen? Equity is increasing due to reserves and debt non-current liabilities falling. Gearing is slightly better. Wherever you can compare with CTR, you should. Better than CTR, and it has slightly fallen in last few years due to slight reduction in non-current liabilities. Right? Your non-current liabilities have slightly reduced. See? Market value of equity is also decreased due to fall in share price, right? Equity market value has also decreased due to fall in share price, and this has also reduced gearing. Gearing is debt over debt plus equity. So non-current liabilities, debt is falling. So this results in fall. Equity is also falling. Okay. So this should have increased gearing. But fall in debt has resulted in decline. Equity is in denominator, it's decreasing the market value of equity. So it should have increased gearing, but still it's decreasing mainly because of the reduction in debt. Now, these last three are investors' perspective. Okay. From investors' perspective, the earning per share is falling. Dividend is stable, although the P ratio is slightly increasing, but the market price per share is also falling, right? Now, I should talk about the investor's perspective. From investors' perspective, the market price per share has significantly reduced. See the market price per share. From 8.93 to 7.56, which will be concerning earnings per share is also falling, and company has not increased dividend. Earning per share is also falling, and company has not increased its dividend payout in last 3 years. So investors may be worried. Investors may also be worried about government not renewing franchise if improvement demands are not met, and these demands will result in outflow of cash. Obviously, government demands to improve facility will result in outflow of cash, which company has to borrow, thereby affecting gearing and profits, at least in short term. So you have covered all the things, but before going to end, let's just give a conclusion. At the moment, GCR cannot be regarded as Very, very bad. It's satisfactory, but it needs to meet government demands of improvement and customer demands to remain competitive and sustainable in long term. So for 10 marks of calculations, and this 10 marks is this, all this is enough for 10 marks. Okay, we have completed this question. You can please copy this.